Welcome back to the Nexus, the Wealth and Freedom Nexus. That is, I'm your host, as always, John Rickard. And today we have another great guest, actually returning guest, my personal insurance agent, Barry Brooksby from Focus Wealth down in Utah. Now, in fact, there's a lot of misconceptions and myths about whole life insurance policies, how awful they are if you talk to some of the gurus, so to speak. Now, to be fair, there actually is, or there are wrong ways to develop whole life insurance policies. And many of these can be attributed to bad decision making and, not so good agents, so to speak. Chris Miles in episode 40 actually walked us through how not all policies are the same and how there is a wrong way to design the policy. And those are the policies that you should not, put your money in. And those are the ones that Dave Ramsey does talk about. But unfortunately, he then thinks all whole life insurance policies are bad. And there are many arguments that I've come across against whole life policies. Some of them are true, or some of them aren't true, and some of them simply are just a matter of opinions. And ironically, I get a number of questions through Twitter, LinkedIn, Instagram, even my email, and it's kind of almost like a circular non-starter where everyone's like, well, are you trying to sell whole life insurance? It's like, well, no, I'm not licensed. I don't sell whole life insurance. I don't have a license to do it, etc. This is just about education. And then later on, they're like, well, you don't know what you're talking about. You haven't been, trained in that. And it's like, well, if I was trained in and had a license, then you'd be yelling at me that I'm just trying to sell insurance. But since I don't have a license and I'm just trying to educate, then you're saying I don't know what I'm talking about. So it just kind of goes around and around. So with that, I did want to bring back Barry Brooksby, kind of dispel some of the myths and probably the most common, I'd say the four most common arguments that I get against whole life insurance. That said, I can attest myself. I have had a whole life policy. I started mine back in 2016. My only regret is I didn't start them sooner. I have used them responsibly to take out policy loans, grow my cash value, grow my net worth and investments, and give me liquidity in life is what I really need. And in fact, I was just looking here and I'll just look it up here for July of 2022. I'll just pull up my account. So actually, I have several whole life insurance policies. And for July of 2022, my cash value increased by $478. This went from a total cash value of about $55,000. And obviously, like I said, went up almost $500. So not quite a 10% increase, but, certainly better than I'm going to get in a savings account, which, oh, by the way, Ally just bumped up their savings rate to 1.25%. All right. Only, let's see, about 7 points below the official inflation rate. So, way to go, Ally. But, just from my own standpoint, that cash value keeps growing. There's two components of it, the guaranteed part and then the non-guaranteed part that comes from dividends. The nice thing about being a whole life insurance policy holder is that you're a part owner in that mutual company. You want to do business with mutual companies, not publicly traded companies. And basically, as a shareholder, you are essentially a business owner. You are entitled to profits from the operations, and those profits come in the form of dividends that go into your policy in regards to the or in addition to the guaranteed guaranteed return that you're looking for. So just kind of a little sidebar here. Those term life policies that, Dave Ramsey, Susie Orman says, buy term and invest the difference. Well, here's a little stat that they don't tell you about. About 98.5% of all term policies don't pay out. Only about 1.5% of term policies actually pay out. So if someone gets a 30-year term policy and it goes, or, someone passes away during that 30 years, well, in that case, it pays out. But most of the time, that 10-year term, the 20-year term, the 30-year term, it expires and all that money goes to the insurance company. And yes, you were insured for that time frame, but, at a 90, let's even round it down, 98% of the time, if the insurance company is going to get all the money, and 2% of the time they're going to pay out. Well, I kind of want to be on the other side of that, where term life policies can be very profitable for the insurance companies. So the dividends that come from the profits, and many of those profits come from other policies that mutual insurance companies sell and provide. So for those of you out there with term policies, I buy term and invest the difference. Well, thank you. Those term policies are going to be about a 98% chance of pure profit to the insurance companies, and that profit will get returned to me in the form of dividends. While dividends certainly aren't, required or guaranteed, pretty much every major mutual insurance company have paid dividends for the last 100, 150, or even 200 years, through the Great Recession, through the Depression, World War I, World War II, the Vietnam War, the Korean War, the dot-com bubble, just to name a few of the major events that we've seen in the United States, where big firms such as Lehman Brothers to Bear Stearns have gone belly up. Lehman Brothers was around for over 100 years. They went belly up back in 2007, 2008. But here, these mutual insurance companies run very conservatively, and used appropriately, a properly designed whole life policy can add a lot of liquidity to your life. Like I said, with that about $500 increase in my cash value that I had across all my policies, that's completely tax-free. If I need to, I can take out a loan against that. It's basically a collateralized loan. Actually, look right here. My policy loan is at 4.9% interest rate. Not a bad rate. Interest only, simple interest paid annually. Even if I want to, I could just pay the interest on that for the rest of my life. And when I pass away, just using very round numbers, if I have $1 million payout in whole life insurance policies, and I have a loan against it of $100,000, basically that $1 million, subtract $100,000 to pay off the loan, and then a net $900,000, tax-free, I might add, go directly to my heirs. So, just kind of, honest discussion. I've been very happy with my experience with Focus Wealth. I'm glad I've been a customer of theirs for 6 years now. Like I said, I just wish that I got the policy sooner. And this is really an episode, or excuse me, a topic that I really enjoy discussing with people and talking about with friends and family, just kind of dispelling a lot of myths, and really think everyone should just take an honest look at it. I will fully admit it's not for everyone. I don't think everyone should go out and get a whole life insurance policy. I do think everyone should at least have some form of insurance. And yes, there definitely is a place for term. I have term policies as well. They have a place in most people's lives, especially when you're, starting out, just, maybe you got a lot of college debt. Maybe you just got married, just had kids, just changed jobs. And yes, term insurance can definitely fit the bill, that if the proverbial Mack truck hits you while you step off the walkway tomorrow, then your heirs are financially secure. I've shared in previous blogs and videos that, I had a high school friend, his younger brother passed away suddenly, age 27, I believe, did not have any life insurance, and actually had a young child and his fiance, soon to be wife, that were in a very unfortunate predicament after he had passed on. My niece about 2 years ago passed away suddenly, just, in her 30s, and just not even sure. Nothing was ever really determined what happened. It was just fluke. She went to sleep and never woke up. Just actually about 2 months ago, down the hall, a good friend of mine, got to know him for several years, that also sold whole life insurance policies. Good friend Ron, a healthy individual, actually talked to him the day he passed, or excuse me, the day he actually had a massive stroke. He passed away the next day, relatively young age at 59. So none of us, like I've preached, time in, time out, and will continue to preach till my dying day, is that life is not guaranteed. Do not defer your life to a later date with the traditional retirement plans, retirement planning, and defer your entire life and stock up this big pile of money in a 401k or IRA until you're 65, and then if you get to that age, of course, then you can live a, life beyond all wonders and everything you want to enjoy then. So like I said, whole life insurance, infinite banking, perpetual wealth, the and asset. This has a number of euphemisms out there. They're basically all the same thing, but it essentially comes down to an overfunded life insurance policy. Bank on yourself, if you will. Highlighted and proposed by Nelson Nash many, many years ago. Highly recommend his book if you have not read it. And just kind of going back down memory lane, first had Barry Brooksby here on my show back in episode 3. He talked about how even banks and many large corporations have whole life insurance policies on their books. Adam Edwards in episode 14 talked about how HELOCs or first line of credits can work very nicely in conjunction with whole life insurance to give you maximum liquidity without being held hostage to banks and their underwriting criteria. Episode 25 had a really great episode with Joey Murray from Wealth Without Wall Street. And finally, like I mentioned before, most recently on episode 40 with the anti-financial advisor, Chris Miles, who he flat out said, yes, there are wrong ways to design whole life insurance policies. And he's not even a fan of those. And those are the ones that arguably Dave Ramsey say are evil. He just apparently gives this huge blanket term of any whole life insurance policy is bad and there's never reason to have one, et cetera, et cetera. With that, I'll just leave you a final question. If whole life insurance is so bad, is so evil, so unfair, such a ripoff, just a horrible product, whatever term you've heard, if it is truly that, why do the wealthy use them almost exclusively? Why does pretty much every wealthy person I know utilize whole life insurance to some degree? Multi-millionaires, multi-billionaire families, family offices, family dynasties, from Mitt Romney to the Rockefellers to J.C. Penney to Walt Disney have utilized whole life insurance policies throughout their lives to help them grow and expand their businesses. If it is so bad, why do so many millionaires and billionaires have it and have utilized them for decades, even centuries, going back to the early 1900s? So just think about that. Maybe start to have an open mind with this. So with that, I hope you enjoyed today's show, and we'll get right to the interview with Barry Brooksby after a word from this week's sponsor. Are you tired of the roller coaster of the stock market? The S&P 500 just had its worst start to a year in over 50 years. The NASDAQ is down 25%. The Dow is in correction territory, and past stock darlings like Netflix are down over 60% year to date. Why not invest in assets that provide constant cash flow and growth unrelated to the stock market? From private businesses to cryptocurrency, the options are nearly endless. I myself have invested in promissory notes, self-storage syndications, a Bitcoin mining fund, and even a teak parcel down in Nicaragua in my retirement accounts. IRAs, solo 401ks, even HSAs don't have to be constrained by traditional stocks, bonds, and mutual funds. And that is why I trust Amanda Holbrook and the specialized trust team with my retirement accounts. Reach out to Amanda today, 505-514-0587, or go to specializedtrustcompany.com for a free consultation today.
Are you tired of the 9-to-5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Welcome back, Barry. How are things in Utah?
Fantastic. Thank you.
Awesome. So, Barry, like I had already alluded to my listeners, I kind of wanted to, bring on an expert, or you in this case, to kind of, dispel some of the myths or questions, or, I'd say kind of like the arguments that I personally hear against whole life insurance. And I kind of have like these main four that I hear probably the most often, or some kind of variation of it. So kind of want to just do like a little rapid fire, if you will, and kind of get your input of like what you would say to that person, or say to the skeptic, so to speak. And then if you have any illustrations or graphs or whatnot to correlate with those, feel free to share them.
Okay, that'd be great. Looking forward to it.
Yeah, so no, this should be fun, and I might put in my 2 cents as well too. But this actually came from one comment, and ironically, he ended up blocking me on Twitter, so I can't exactly put a link to the Twitter feed and comments and whatnot. But as he put it, I have no debt. My kids are grown and out of the house. I have a 2 million net worth. He doesn't expand on that. He just has a 2 million net worth. Why would I need life insurance? So I'm guessing in your career, you've heard maybe not exactly the same, but I'm guessing some kind of a talk track along these lines of like, well, I'm a multimillionaire. I have money flowing out of my ears, or whatever the case may be. Why do I need life insurance?
Yeah. And I've been doing this now for 22 years. I have clients all across the country, and my expertise is in helping clients design very high cash value whole life infinite banking policies. So we aren't purchasing these policies right out of the gate for the death benefit, but I'm going to answer the question in 2 ways. Number one, if you want to grow your money guaranteed, have liquidity, and that money also be growing tax-free, there's no better place to put money than a high cash value whole life policy because of all the multiple benefits. Mm-hmm. The death benefit in this person's situation, I would say this: if he doesn't have any life insurance later in life, it will put a lot of pressure on his assets to perform. Mm-hmm. If he has market-based money or 401ks or IRAs, if you don't have life insurance in retirement, you have to hope that your assets perform, because when you pass away, guess what, John? Those assets become your life insurance for you. Mm-hmm. You're going to die and you're going to leave something behind. What I tell clients is a death benefit is a permission slip. It's a permission slip for you to spend and enjoy your $2 million or whatever assets you have. He gets a retirement, he might be worth $2 million, but he may not spend all that money because he's fearful, as most retirees are, of running out of money. Mm-hmm. If he had a $2 million death benefit and $2 million in assets or investments, he could easily spend and enjoy his $2 million, knowing he has the death benefit that will come in and replace the money that he's spent.
Yeah, that makes sense. Kind of funny how you mentioned that with the permission slip, so to speak. I know my older brother, he's always, he's still a ways from retirement, but him and his wife have done very well with, traditional investing, saving for retirement. But as he always joked, is like, I want that last check to bounce. Our kids are on their own. So, and again, kind of back to that permission slip, I know they have life insurance policies, to take care of, even just estate and, things that transpond after a death. I think a lot of people don't even realize just how expensive, funeral costs are. And, depending on how you want those there, and yeah, like you said, okay, I might have a $2 million net worth today. Well, if we have another Great Recession or .com crash, maybe that 2 million turns to 1 million and then something happens.
That's right. And I was on a call yesterday with a client, and he was really pushing me like, why should I do this? Why should I do this? And I asked him 2 or 3 very simple questions. And I would ask these same questions to this gentleman. The first question is, if you had 3 buckets of money, tax deferred, taxable, and tax-free, which bucket of money would you prefer to have? Well, 10 out of 10 people, John, answer tax-free. But my next question to him was very telling. I said, well, how much of your money right now is in the tax-free bucket? And guess what his answer was?
I'm guessing 0. Yeah.
0. So I was very deliberate in helping him see clearly his tax situation in the future could be a ticking time bomb, especially if it's 401k and IRA qualified money. That's all tax deferred. And if taxes go up because the US is now $30+ trillion in debt, people are going to want massive amounts of tax-free money. And these very uniquely designed whole life policies allow them that. My second question to him was how much of your current portfolio is guaranteed. And you just talked about this. Maybe this guy's 2 million is going to erode to 1 million. But we also want guaranteed money in our portfolio. You don't have to put all your money in a whole life policy, but how much peace of mind would you have knowing you had tax-free money and guaranteed money in your portfolio?
Well, and I mean, on a side topic, I've always liked the kind of the asset protection, aspect of it too, that I don't think a lot of people talk about. I know years ago, I think it was a podcast with, I remember it was Andy Tanner that was mentioning it, and not that I'm, okaying criminal behavior or anything by any stretch of the means, but a lot of the Enron employees, with all the shenanigans they did with the fall of Enron, and they were trying to, sue the higher ups. And they actually got to the point, it's like they had huge cash value life insurance policies. And yes, they were guilty as sin. Yes, they had all the evidence against them, but they actually couldn't touch the cash value that they had put in their whole life insurance policy. So again, I'm not giving a permission slip to, hey, go out and commit crimes and open up an account with Barry Brooksby. You'll be fine. But just to highlight, the asset protection is pretty well solid and well established for some time.
Yeah, it's huge. If you're a business owner or a real estate investor, one of the safest places to store cash is in a whole life insurance policy.
Yeah, I agree. And I think that's what, there's a misconception. People like to say, well, it's a horrible investment. It's like, well, I don't think of it as an investment. I think it's just as a tool, if you will, a liquidity tool or a place to park cash and utilize it later too. So, but
yeah. And speaking of investment, some people I've heard call it an investment, others don't. But when you're earning that guaranteed rate of return and you get a dividend from the insurance company on an annual basis too, the returns actually are pretty good.
Yeah. And like you said, tax-free. And, even now, if you put something in a savings account, which I just alluded to, that Ally Bank just bumped up their money market account to 1.25%. Well, if you earn even as little as $10 in interest, you're going to get 1099 and be subject to your highest marginal tax rate on that little minuscule interest. So
yeah, that's true.
But so kind of going down, this is kind of a question, not really in a question format. This is actually from a YouTube comment. Everyone on YouTube, of course, is a genius, but this was a comment. By all means, open a savings account with me, and I'll let you borrow against your own money while you make 6% interest payments back to me, and I'll keep your balance, period, Nimrod, period. Or I think a roundabout way, I've heard this before. It's like, well, why should I have to pay money to borrow my own money? That just doesn't make any sense. I'm sure you've heard other, maybe not as in a, sophomoric language as this YouTuber, but maybe in some other context, you've heard it before.
Yeah. What he's missing in his question is the understanding of how a policy loan works with a mutual insurance company. And maybe I'll draw something out here, John, if you would like to see this.
Yeah, for those of you listening to this is also on YouTube, so be sure to subscribe to my channel and see what Barry's drawing here.
Great. And I'll talk through it for those that aren't able to see it. But I want to talk about a policy loan. And what's interesting about this is that you're still making money on your cash value when you have a policy loan. And these are the details that I want to share.
Okay.
Get my screen here. Here we go. Right on. So I've drawn out a compound interest growth curve.
Okay.
And I want to just quickly show an illustration as to how cash value builds. And I actually did this for the Wealth and Freedom Nexus. So
sure. Perfect.
This is a policy with $25,000 a year going into it.
Okay.
And it's been properly structured with what's called paid up additions, or PUA. It turbocharges the cash value growth.
Okay.
In a traditional whole life policy, there would be $0 of cash value in year one.
Okay.
But because we're using that turbocharge rider, you see the cash value here continuing to grow year after year.
Okay.
So we'll just make an assumption here at year 4, this person wants to take a $50,000 loan and they have $93,000 of cash value.
Okay.
So coming to the whiteboard, we'll write out the $93,000 in cash value. and a $50,000 loan. And what happens is on this loan amount, the person simply calls the insurance company or goes to the app and requests a loan. They receive the money direct deposited to their bank account within 3 to 7 business days. There's no questions asked, John. The insurance company doesn't care what you need the money for. There's no application and there's no credit check, right?
Yeah.
We're real estate investors, so we wouldn't know what it's like.
Oh, yeah.
Loans, right? These are very simple loans. But here's what the person is missing in the YouTube comment. What's happening is this $50,000 loan really is a loan from the insurance company.
Okay.
You're not physically removing money from the $93,000 cash value. So yes, you are paying interest back to the insurance company, which today is around 4%.
Mm-hmm.
But you're still earning interest and dividends on your total cash value, which means you're still making money on the 93,000 and it's compounding. Whereas on the 4% that you're paying, it's principal reduction. So imagine if this straight line represented the dollar amount of 0. You take the loan, you pay it back over time, which means you're paying back less interest over time.
Sure.
But your 50,000 is still compounding.
Okay.
And one of the things I like to show here, just in a quick chart, if you have a $50,000 loan balance, because this is your own bank, John, you get to determine how you want to pay it back. Right? The insurance company isn't bugging you about, hey, you're forced to make a payment. If you're a real estate investor, you may not want to make a payment back for a year. Maybe you're doing a rehab on a property, you know. But let's do the 4% loan rate, and let's say over 5 years.
Okay.
So this would put us at 60 months, and the payment would be $920. So at the end of that time frame, they would have paid $52.50 in interest. So I'm going to write that down. $52.50. And this went back to the insurance company.
Yep.
You do have to pay interest back to them. But your $50,000 didn't leave your cash value. So we're going to look at a future value calculator and what happened to that $50,000. Now, most policies are earning 5% tax-free.
Okay.
But I'm going to be fair. Okay, we're not going to show any arbitrage, at least in this example. We're going to use the same 4% return.
Okay.
But because the money's compounding, that 50,000 turned into 61,050. So the difference is $11,050. And you look at the difference between the 11,000 you earned and the 5,200 in interest you paid, you still came out ahead a positive roughly $6,000.
Sure. Okay. And kind of like you mentioned there too, obviously the loan you're taking out, it's basically just a simple interest. It's not compounding interest on interest. Whereas the growth that's compounded.
It's an amortization schedule depending on how you set it up.
Okay.
But notice that when you pay it back, you're paying less interest over time because the balance of the going down.
Gotcha.
Yeah. Yeah.
Okay.
So people need to understand that with a whole life policy, a properly structured high cash value policy, they're still making money inside the policy, and they're able to go take loans to buy real estate or invest in their business or make other investments that they want to.
Gotcha. And then, like you said, there's no credits, credit hit like with a traditional bank. Then I'm also assuming technically this is shall we say, a private agreement or private loan. If you do have a policy loan, you can get, your credit reports from TransUnion, Equifax, whatever, and it's not going to show on there, correct?
That's right. It does not show reportable on your credit.
Cool.
Yeah.
So yeah, in many ways, I don't know. I kind of like the illustration. You're taking out a loan and, then you're paying it back, but your cash value is growing. And, we could even dive down. It's like, okay, let's say you're investing this money and, doing a fix and flip, a BRRRR method for a, property and then reselling it. And I don't know, maybe that $50,000 loan, you I don't know, let's just be conservative. Say you turned it to 75,000, it was a 50% return. Well, that's $25,000 of profit, deduct roughly 5,000 in interest, pay back the loan. Well, now you're sitting at $20,000 pure profit. Well, maybe we open up another policy. Well, we're close to a $25,000 annually, but that's just kind of a circular growth machine after that.
That's right. And John, if you look what the truly wealthy do in this country, they buy assets.
Mm-hmm.
And they leverage those assets.
Yeah.
A whole life policy is an asset. We're just simply showing people how to leverage that asset.
Mm-hmm. Yeah. Yeah. I know the progressives like Bernie Sanders and some of them like say, oh, well, Elon Musk and Jeff Bezos and all those evil people, they don't pay any taxes. And so, unfair, blah, blah. It's like, well, at the end of the day, they have millions of dollars of stocks and they're taking out collateralized loans against it, which loans aren't taxable. And this is essentially the same thing. And, I think for everyone that complains about that, it's like, well, you must not have a HELOC that you're taking money out against your house or home equity. So it's kind of like, just because I don't have $100 million in stock that I can take a loan out against doesn't mean that I can't utilize that to my benefit, even if it's just a, small $50,000 cash value policy.
That's right.
So cool. All right. Well, thanks for illustrating that, Barry. And for those of you listening, just be sure to check over to my YouTube channel to see the full graphs of that. Do we want to move on to the next one, or do you have anything else you wanted to show on the policy loan portion, Barry? Or
nope, this is good. Let's go to the next question.
Okay. So let's see here. Now, this gets kind of into a little, shall we say, sensitive topic. And I myself actually opened up a policy, just a small one to start off with on my son 2 weeks after he was born. And a lot of people are like, I don't need life insurance on my kids. They aren't bringing in an income and no one is dependent on them if something died. I mean, obviously, if a child passes away, I mean, obviously it's tragic and very emotional for the parents, but unless were parents to the Olsen twins or something, I don't think they, are really dependent on income. And I think a lot of people just say, well, they're not a breadwinner for the family. I don't need to get insurance on them. I'm sure you've heard that numerous times, but what's with your expertise, or why would you recommend, a young person getting an insurance policy?
Yeah. So I'm going to share this. I own policies on my kids, and notice the key word here. I'm the owner.
Okay.
So I can insure my kids. I can put extra cash into their policies, but they're my policies. I'm the owner.
Okay.
So I can choose to take loans from their cash value. I can choose to take retirement income off of their policies.
Okay.
And I don't have to pay those loans back in retirement, John. But when I pass away, my life insurance death benefits will pay off those loans, plus give the kids a lot of extra money, tax-free. And so it is a perpetual circular way to create more wealth.
Okay.
And it's allowing the generation after me to have more wealth. And then I hope my grandkids have more wealth than my kids. This is what the Rockefellers have done, the Rothschilds have done, the Kennedys have done. They keep this wealth perpetuating because there's no better way, in my opinion, to transfer wealth than tax-free life insurance death benefit, right? Real estate's fantastic, but I still don't think that stacks up to tax-free life insurance death benefits because you get so much bang for your buck.
Mm-hmm.
And think about this. What if you never use the policies? So if I never use the cash value in my kids' policies, but I leave it to them later, boy, I've set them up for a tremendous future because now they have cash that they can invest in businesses. They could go buy their own real estate portfolio. They have money that they could use for college or weddings or maybe their first home. And the reason you want policies on kids is because the time value of money, right? They have a lot more time ahead of them for compound interest. You saw me go through this compound interest growth curve. These policies are always making more money from 1 year to the next because of the compounding. And there's probably not a week or at least a month go by where one of my clients doesn't say to me, Barry, I wish I would have done this 20 years ago.
Yeah.
So now your kids are in that position where you can take advantage of the time value of money.
All right. Sounds good. One little maybe side note, and I don't know what your thoughts on this. Would you also just kind of on that segue? Obviously, we have the time, compounding, over 40, 50, 60, maybe more years versus 20, 30, 40. But just, life changes, things happen. I've always been told, or another one of my insurance agents always said, getting life insurance ensures your insurability, because if you open up a policy on your kids and, let's just say little Ronnie is 10 and everything's fine, open up a policy, but then fast forward, I don't know, age 14, leukemia or another form of cancer or Crohn's disease, or I'm sure there's a laundry list of other ailments out there that an insurance company is just going to say, oh, we're not covering you anymore. Or maybe best case scenario, well, we'll cover you, but it's about 3 times the cost of what we would have insured you for when you were age 10. Do you see that a lot, or see that as still prevalent?
I have seen it, and I often will visit with clients and talk to them about what's called the security of maximization. Okay. We all have a human life value, and children do too. What an insurance company is willing to insure you for. You can't be overinsured unless you lie on an application. It's kind of like if you have a home worth $1 million, and you walk into your homeowner's agent tomorrow and say, hey, I want to insure my home for $2 million. What's he going to tell you? Right? It's going to be like, forget it. Even if you want to pay the higher premium, he's still not going to insure your $1 million home for $2 because it's not worth that. Well, our lives have value from a monetary perspective, from an insurance company perspective. And I tell clients, you want to try to get as close to your human life value as possible. And that's one of the reasons maybe down the road, you become uninsurable and you can't get any more life insurance.
Yeah. Yeah, makes sense. And maybe just high level, like what are some, I know everyone's situation is different, but like what are some generally speaking, some ailments, whether young or old, that once you are diagnosed, like, oh, you would have been insurable before, but now you're not?
Well, cancer is a big one, right? Heart attack is a big one. Even some type 1 diabetes could be a potential no, but here's what's great. I would say that 90+% of my clients get approved. Okay. So it is rare, but
I'm in that 90%.
That's right. I have seen some declines, and usually it's like 2 heart attacks, or there is cancer, or something very extreme. But insure your life now while you're healthy, because no one knows what their future holds. John, I've had people in underwriting with applications, and they've passed away while we were getting their approval. So geez. Yeah. So sad. So get some policies now.
Yeah. No, and I think and actually just as it popped to my mind, I remember a friend and coworker way back in my high school days when I worked at Sam SuperValue. I think he was diagnosed, I want to say he was 13 or 14. He was diagnosed with leukemia, and I haven't talked to him in years, but just you mentioning that, and, obviously when we're 13, 14, we don't think about life insurance, but I'm willing to bet he probably isn't insurable since then, or today at this point.
Yeah.
So, all right. Well, yeah, I definitely like the answer for that. I think for anyone with children out there, we've already just kind of given a few notices or examples of what would make sense. Maybe in a closing, Barry, this I've kind of seen a number of different ways, and I think there's a lot of myths with it. I know you've kind of gone over some examples, but I think the Dave Ramsey's per se, they say, well, you get term life insurance, you pay $100 a month, and it's for 360 months or whatever the term is, and then you're done. You don't have to pay it anymore. And whole life insurance premiums, you just have to pay them forever, month in, month out, till the day that you die, basically. What would you say to that, or what are maybe some options for that with whole life insurance policies? Do you have to pay them till you're on your deathbed, or are there some flexibilities built in to adjust your policy, adjust your premiums and whatnot?
The policies that I design for my clients have flexible premiums.
Okay.
Which means they can fund a maximum amount, they can fund a minimum amount, they can fund any amount in between. And there can come a point where they can completely stop the premium.
Okay.
In a traditional whole life policy, yes, they may have to pay for a very long time, but in the policies that I design, I naturally build in flexibility.
Okay.
And I want to just quickly share a little bit of that in this illustration here that we first looked at. What I did is I ran premium. For $25,000 a year.
Okay.
This is on a 40-year-old for 20 years. And then just for 5 more years, I reduced to the minimum. So think about this. On a $25,000 a year premium, this individual could go as low as $4,900 a year.
Okay.
And they could do that in any year. You don't have to wait till you're 61.
Okay.
So they could go up and down, or they could fund any amount in between that. Well, at this point, they would have put in $524,000, but they're sitting on about $1,060,000 cash value and almost a $2 million death benefit.
Okay.
What I'm doing starting age 66, John, is no more premium going in. So the premium is zero. So this is an example of them not having to pay premiums their whole life. So it is called whole life insurance, but I like to build in the flexibility. And not only that, not only do they stop the premium payment, but I show them now taking income out for retirement at $65,000 a year.
Okay.
So I ran this from the age of 66 to 90, which is $1.6 million in tax-free income on a $524,000 investment.
Wow.
So it gave them the flexibility to put in 25 or as low as 4,900 to stop premiums altogether and begin a tax-free stream of retirement income. 1.6 million tax-free, and if they pass away at 90, they still leave their beneficiaries a $382,000 tax-free death benefit.
Or at age 94, turn 60. Is out of curiosity, do they zero out at age 105, or where's it kill off at?
So what happens is this is a policy to 121. So if they live to age 121, the life insurance company is going to give them a check for $74,000. Plus, they would have had the 1.6 million in tax-free income.
Okay. So, all right. Although I don't know if world record is 121. I think it's actually under that. All right. And maybe just as a final note, great illustrations, and thanks for sharing this, Barry. Structured properly, not all whole life insurance is the same, and get a tax-free income stream, and you don't have to pay $25,000 a year for every year for the rest of your life, or whatever the number is. If just, whatever life happens, someone just says, I don't think I want this, I don't think I need this, or just something, out of the blue comes out that they need maybe hundreds of thousands of dollars, can you just cancel a policy? Can you sell it? Can you terminate it, change it to term? Like, are there any other options available? Or
there are. Matter of fact, everything you just said is an option. They can sell a death benefit. It's called a viatical settlement or a life settlement, where you can sell your death benefit. I actually had a client do that.
Okay.
So it is possible. You can also take out your cash value if you surrender. Now, I usually don't recommend surrendering a policy. There are no surrender charges in a whole life policy, but say this person at age 57, they're like, look, I'm done. I don't want it anymore. They would have put in $425,000. The insurance company would send them a check for $627,000. They would have to pay tax on the $200,000 gain. Because in order to keep the money tax-free, you do have to keep the policy in force until you pass away. But in a worst case scenario, if they want to surrender, they simply get the cash value of the policy in that given year.
All right.
And then finally, the third option is yes, they could turn it into a term insurance policy
Okay.
if they wanted to. Yeah.
Oh, interesting. Okay. So, all right. So there we just dispelled one of the big Dave Ramsey myths. You do not have to pay those premiums till your dying day. There are options out there. With that being said, I hope at least one of my listeners maybe are, a little bit more open to this idea. If anyone did want to reach out, Barry, and maybe run their own specific life circumstances, design their own policy or wealth plan, if you will, what's the best way to reach out to you?
Yep. My website is Focus Wealth Group, focuswealthgroup.com. They're welcome to call my office. I'll just put a little thing up here on the screen. And I love to run numbers for people, John.
Okay.
I like them to see their own numbers so they get an idea as to how a policy would work for them. And that's really when the light bulb comes on, when you can see your own numbers and you understand how is the cash value growing for you, what's the death benefit like, how you can take policy loans to leverage and go buy more real estate or buy more assets. It's really fun. So there's my contact information on the screen, focuswealthgroup.com, and would love to visit with anyone that's interested.
Perfect. Sounds good. And yeah, for anyone listening, like I said, feel free to go on the YouTube channel and subscribe. Otherwise, I will have the contact information in the show notes to reach out to Barry. He's been a great advisor and friend to me for the last 6 years, and I know he can help many out there as well. So with that, thanks for dispelling some of these myths. And as always, great to have you on the show, Barry.
Thanks for having me, John. I appreciate it.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.